Running an online business is an exciting venture, but one that comes with many challenges. Unexpected expenses, increased liabilities, and cash flow disruptions can stagnate or even break your growth. Because you sell online, you need to be even more diligent about managing and growing your business. Generally, a business in good financial health will have positive working capital. On the other hand, having negative working capital is usually a sign that something's not working. But in e-commerce, it's not that simple. Complex supply chains, long payment terms for marketplaces can mean that e-commerce companies look like they have negative working capital when they're actually quite healthy. Understanding the importance of working capital and how you effectively improve it is key to a healthy e-commerce business. Working capital is defined as your current assets minus your current liabilities. This determines what cash is available to cover your daily operations, inventory purchases, and to fund growth plans. Essentially, if at any time your expenses exceed your assets, working capital is the cash that you need to keep your business running. In e-commerce, this formula is just too simplistic. As an example, if you bought inventory early and got a better price, but that inventory is currently in China and you have record sales on Amazon, but Amazon won't pay you till next month, your working capital and cash flow will be squeezed, but your business will be in good shape. As you increase your sales online, you need to finance more inventory or boost other areas of your business. Even if you are already a profitable online retailer with minimum overheads, you need to secure additional funds to grow the business. There are 3 aspects you need to consider to create a healthy e-commerce company. Inventory. This covers all the products and goods you keep in stock. Receivables. These are completed, but yet to be paid sales. Payables. This is the money that you owe to your suppliers. As you continue to sell, the revenue grows, but so will the financing requirement. This will impact the working capital you need to operate and grow a successful business, and where external financing tailored to your business may be the best solution. A lack of working capital can be serious for your business. There are a number of different paths available for you if your business wants access to working capital. However, not all working capital solutions are equal. Receiving and successfully paying off a bank loan can improve your credit score and help your business get more credit. Still, banks tend to be cautious in their lending, and it can be difficult for an e-commerce business to get approved for what they need. As we mentioned, conventional metrics don't work for e-commerce companies, and they can even make e-commerce companies look like they're in trouble when in reality, they're very healthy. That's why banks often require collateral, and the process moves more slowly than other financing options. You also need to be in business at least 2 years, and they might ask the founder to personally guarantee the loan, which would put your financial health at risk. Applying for a credit card usually results in fast approval and avoids the paperwork required for a bank loan. Getting a business credit card can be quick and easy, letting you access capital for your business, but they typically have very high interest rates. Also, if you've been in business for less than 3 years, you may not be able to qualify for it. Finally, many foreign suppliers simply won't accept American business credit cards. Another option is factoring. Factoring can provide a quick boost to your cash flow when you are short on working capital. It's when a company pays you today for an invoice that your customer will pay you in 30 days or whatever. The company then takes full payment on your behalf from the customer when the customer pays. The challenge here is that the company selling you the factoring will take a strong percentage of your sales, and you will need to tell your customer or the marketplace to pay the factoring company instead of you. Finally, this is only designed as a stopgap to fix short-term cash holes. it's not designed as a way to help you invest to grow your business. These factoring companies also require contracts. Some may lock you into 24 months and oblige you to sell all of your sales through them, even in periods where you aren't experiencing any cash flow crunch. This means you could unnecessarily lose profits. Alternatively, many e-commerce businesses that don't have enough working capital use online funding platforms that provide access to working capital advances. Unlike a business loan, which requires collateral, a working capital advance is an advance on your future sales revenue. The funding provider simply purchases a portion of your future sales income and gives you access to that money now. Unlike factoring, where the advance of money is very short term, with a capital advance, you have a longer term repayment. You're essentially given fast access to cash. The approval process is quick and simple, and there are no restrictions on how you choose to invest your money. At Yardline, we work with e-commerce businesses, which means we understand the challenges that you face when it comes to financing. We give online sellers like you access to growth capital so that you can boost and scale and invest in building a healthy business. Kick things off today by filling out a 3-minute application, and you could get as much as $1 million in funding within 24 hours.